As the market is currently closed, we are looking at the final figures from Friday, November 14, 2025. Circle Internet Group, trading on the New York Stock Exchange under its ticker CRCL, ended the session at $81.89 per share. This represented a decline of $0.45 or 0.55% for the day. But that single-day figure, that simple $81.89 close, is profoundly misleading. It doesn't just represent a quiet Friday, it serves as the grim punctuation mark on one of the most brutal and confusing weeks for the company since its massive public debut. This $81.89 price isn't the story, it's the evidence left at the scene. The real story, the one that should have every single person holding this stock on their Fidelity or Robinhood app completely reassessing their position, is how it got here. Because this past week, Circle did something that markets are supposed to love. It reported spectacular third-quarter earnings. And in response, the stock didn't just dip, it utterly collapsed, shedding nearly 20% of its value in a few short days. This is the central paradox of CRCL right now. The expectation, the narrative that has been carefully built since its blowout IPO back in June 2025 is one of dominance. This is the company. It's the issuer of USDC, the world's second largest stablecoin, the regulated, transparent, US-based digital dollar that is supposed to be the backbone of a new financial system. When the company went public, it wasn't just another tech listing, it was seen as the financial world's seal of approval on the stablecoin industry. The IPO itself was a massive success, pricing at $31, opening at $69.50, and closing its first day at $83.23. The expectation was set. This was a growth and safety hybrid, a way to get investment exposure to the crypto world without the volatility of other assets, a blue chip in the making. Investors, whether they were doing self-investing on SoFi Invest or being managed through Fidelity Wealth Management, saw CRCL as a core holding for the future. But reality, as it so often does, has delivered a brutal counter-argument. If Circle is the future, why is its stock trading today at $81.89, below its first-day close, after having been as high as $298.99? More importantly, why did the stock just implode after the company posted fantastic numbers? Let's look at what was actually reported on November 12th. For the third quarter of 2025, Circle announced total revenue and reserve income of $740 million, a 66% increase year over year. Net income came in at a staggering $214 million, a 202% surge from the prior year. USDC in circulation, the absolute core metric of its business, grew 108% year over year to $73.7 billion. By every conventional measure, this was a home run. It beat analysts' expectations. It showed massive growth. The expectation was that the stock would rally hard. Instead, the stock fell off a cliff. The day of the earnings, it plunged. The next day, it continued to bleed. Why? Because the market, in this case, is not looking at the past 3 months. It is looking ahead 18 months, and it is terrified. The reality that has shattered the bullish expectation is the macro environment. Circle's business model, while multifaceted, has a massive driver: interest income. The $73.7 billion backing USDC isn't stuffed in a mattress, it's held in cash and short-term U.S. government securities. In a high-interest rate environment, Circle prints enormous, high-margin revenue simply by holding these reserves. That $214 million in net income, it's heavily fueled by the Federal Reserve's rate policy. And the market is now betting that the Fed is done hiking and will begin cutting rates aggressively in 2026. This is the existential threat to the stock's valuation. The fear is that Circle's earnings are at their peak, and a cycle of rate cuts will systematically destroy its profit margins. The strong Q3 report wasn't seen as a sign of strength, it was seen as the good old days just before the income stream gets turned down. This disconnect has created an absolute battleground among Wall Street's biggest names, and it's a fascinating fight to watch, especially for anyone looking for investment help or trying to understand where the smart money is going. On one side, you have the bears. Mizuho Securities, for example, came out just yesterday on November 14 and reiterated their underperform rating. They slashed their price target to $70. Their argument is precisely the one we just discussed. They're skeptical about consensus revenue, they see slowing rates, they see stablecoin commodification, a fancy term for competition, and they see rising distribution costs. They're looking at that $81.89 price and saying it's still too high. They believe the market is not properly pricing in the risk to Core's revenue engine. But then, on the other side, you have some of the biggest bulls on the street. On the very same day Mizuho was downgrading, Baird upgraded the stock. They looked at the same earnings report, the same post-earnings crash, and declared it a buying opportunity, upgrading CRCL to outperform with a $110 target. And even more aggressively, JPMorgan, one of the most powerful banks in the world, came out this week and issued a double upgrade, taking the stock to overweight with a $100 target. And perhaps most notably for the retail online investing community, Cathie Wood's ARK Invest has been on a buying spree. Public filings show that as CRCL stock has been crashing, ARK's funds, the flagship ARK Innovation ETF ARKK, the ARK Next Generation Internet ETF ARKW, and the ARK FinTech Innovation ETF ARKF have been gobbling up millions of dollars worth of shares. These are not small purchases. These are high conviction buys. Cathie Wood is looking at the exact same data as Mizuho and coming to the polar opposite conclusion. This is the kind of high-stakes drama that defines markets. Far more than the noise around Tesla stock or Apple stock on a given day, this is a fundamental disagreement about the future. It's a clash of titans, with funds likely using sophisticated platforms like interactive brokers to manage their positions, while retail traders on the Fidelity mobile app or Robinhood stock trading platform are left to wonder who to believe. It's a clear divide. You have JP and Cathie Wood on one side, Mizuho on the other. Down in the comments, let me know. Are you siding with the bulls or the bears on CRCL right now? Are you buying this dip, or are you convinced the rate cut fears are real? To understand this fight, you have to understand what Circle is beyond just the USDC stablecoin. The bull case, the one that JP and Cathie Wood are making, is that the market is myopically focused on interest rates and is completely missing the real story, the growth of the platform. Circle isn't just a bank, it's a technology company building a new financial infrastructure. They just announced the launch of the ARK public testnet with a potential ARK token on the horizon. This is their play to build a new programmable layer for global finance. They are expanding their Circle Payments Network, CPN, which already has dozens of financial institutions enrolled and hundreds more in the pipeline. They've announced major partnerships and collaborations with giants like Brex, Deutsche Börse Group, Fireblocks, Kraken, and Visa. The bull argument is that even if interest rate revenue flattens or declines, the revenue from these new platform services, transaction fees, developer services, and network participation will explode. They believe the 108% growth in USDC circulation is the key metric, as it shows accelerating adoption of the network. More adoption means more users for their new, high-margin platform services. The bulls see the current stock price as a ridiculous discount, a chance to invest online in the future of finance because the market is fixated on a short-term macro headwind.